Hello, everyone, and welcome back to The Deep Dive, the only show dedicated to giving you, well, the architectural blueprints of the global digital economy. Today, we are taking you straight to the heart of Silicon Valley to break down the company that is perhaps the most indispensable yet, least understood player in the entire technology landscape. Applied Materials, ticker AMAT. I mean, think about it this way. If the digital economy is a skyscraper, Applied Materials is selling the specialized cranes, the advanced scaffolding, and the atomic-level concrete needed to construct it. They are not making the chips you buy. They are the foundational technology provider, the ultimate picks and shovels play. But we are not just analyzing a cyclical industrial giant today. We are looking at a company positioned at the transition point between the nanometer era and the Angstrom era. And that shift, well, it fundamentally re-rates the business. So here is our high-stakes central question for this deep dive. Does AMAT possess a technological moat so deep, so wide, and so reinforced by recurring revenue that it qualifies as a truly wonderful company for long-term compounding? Or is the current premium valuation ignoring the fierce structural geopolitical headwinds and, the inevitable cyclical gravity that has always plagued this industry? We are going to unpack the business physics of that question right now.
That is the perfect starting point, because it acknowledges that what we are analyzing is far more complex than a typical equipment vendor. Applied Materials sits at the intersection of material science, geopolitical risk, and the accelerating demand for AI infrastructure. It's a massive scope. But before we dive into the details of atomic manipulation, a quick but important housekeeping note for everyone watching.
Absolutely. For those who are synthesizing these investing ideas and are ready to act on them efficiently, having a professional-grade trading platform is absolutely key. We've partnered with Interactive Brokers, and they are offering a stock bonus for new viewers who sign up using our dedicated link.
So you get access to one of the world's most robust trading platforms, you potentially get a stock bonus, and importantly, you help support the channel that brought you this level of deep dive analysis. That link is fully vetted and available right there in the description below.
That's right. And if you find this kind of exhaustive analytical discussion valuable, if we saved you dozens of hours of research, the best way to let us know and to ensure you receive the next deep dive is to subscribe and hit that like button. It truly helps us immensely to justify bringing this level of detail to you. And please use the comment section to engage with us regarding our analysis of AMAT.
Perfect. With that done, let's pivot back to the core material. We need to begin our analysis by understanding the single most powerful secular shift driving AMAT's valuation: the failure of traditional Moore's law and the transition into the Angstrom era.
Okay, let's unpack this shift because this is the fundamental reason AMAT is being re-rated by the market. For decades, the entire semiconductor industry revolved around Moore's law, right? Shrink the feature size, lower the cost, increase the performance. But you are asserting that the physical mechanism that defined that growth 2D optical scaling is now fundamentally hitting a wall. Why is this happening, and why does that shift the value proposition toward Applied Materials?
You get the nail on the head. Moore's law isn't dead, but the way we execute it has changed drastically.
Yeah.
We are transitioning from the nanometer scale, which is, 10 to the negative 9 meters, to the Angstrom scale, 10 to the negative 10.
We're building with atoms.
We're talking about building with individual atoms. And traditional scaling relied almost entirely on advanced lithography, basically using light and chemistry to print smaller and smaller patterns horizontally on a flat plane.
Right.
But once you hit the limits of silicon physics and the wavelength of light, you can't just shrink horizontally anymore. You start running into severe performance compromises like electron leakage and overheating.
So if the chips can't get better by shrinking horizontally, they must get better by building vertically. How does that translate into, say, capital expenditure migration?
It creates a massive value migration. All that CapEx money moves away from patterning, which is a part of the process dominated by lithography companies.
Like ASML.
Exactly. And it moves straight into the creation of physical structures, which is AMAT's bread and butter: deposition and etch. If you have to stack features three-dimensionally, you need precision tools to build those layers and precision tools to carve them out. The CapEx burden moves from printing lines to creating atomic scaffolding. This is the crucial secular insight for AMAT.
And this structural transformation feeds into their overarching strategy, the PPAC Flywheel. I've heard them talk about this. It's not just about smaller chips, but fundamentally more efficient ones.
Precisely. PPAC is their strategic framework. It stands for improvements in power, performance, area, cost, and time to market. They are telling their Foundry customers, look, don't focus exclusively on shrinking the area. focus on co-optimizing the structure to reduce power consumption and increase speed.
Which means new materials.
It requires radical new materials and processes that only AMAT can provide, ensuring their tools are necessary at every single stage of complexity.
Let's delve into the mechanics of their core business then. The Semiconductor Systems segment, which generates nearly 3/4 of their revenue. AMAT operates across 4 core competencies that allow them to manipulate matter at the atomic scale. Give us the rundown on what those processes are and why they are becoming exponentially more complex.
Sure. So the 4 pillars, they basically define atomic manufacturing. Starting with foundation, you have deposition. This is the process of adding material to the wafer, often one atomic layer at a time. We are talking about chemical vapor deposition, or CVD, physical vapor deposition, PVD, and the extremely precise atomic layer deposition, ALD. AMAT is the undisputed leader in this space. Now, this is where the materials engineering shift becomes so critical.
Right, because for decades, chips relied on copper wiring for interconnect. Why is that changing, and what materials are replacing it?
Copper is running into a wall. Specifically, electron migration and high resistivity issues once the lines shrink past about 7 nanometers.
They just get too thin.
They get too thin and electrons start jumping around, creating noise and heat. So to solve this, AMAT is leading the transition to new exotic materials like ruthenium and molybdenum for these interconnects. These materials offer better electron mobility and stability at Angstrom dimensions. And their legacy Endura platforms, which used to handle copper, are now being upgraded and qualified to handle these entirely new material recipes.
So the installed base gives them an advantage.
A huge one. It ensures they maintain dominance through the transition. Next, you have etch. If deposition is building up, etch is selectively removing material. And this is a brutal high-stakes process using specialized plasmas to carve complex, often vertical structures.
And this is where it gets competitive.
Very. Lam research has historically been strong here, but AMAT is rapidly gaining share in specific complex areas, particularly dielectric etch, and these high aspect ratio applications needed for memory. The third is doping and treatment, which uses processes like ion implantation to modify the electrical properties of the silicon. It basically decides where electricity flows and where it stops.
Less glamorous, but critical.
Absolutely critical for transistor function.
Yeah.
And finally, metrology and inspection. I mean, you cannot build features 100,000 times smaller than a human hair without instantly checking your work.
Right, you'd be flying blind.
These tools are the sensory systems of the factory, ensuring yield and preventing catastrophic process errors that, as you mentioned, can ruin a $50,000 wafer. The measurement tools must be as precise as the manufacturing tools.
Okay, now, let's tie this back to the macro trend, AI. We keep hearing about the AI boom driving AMAT. Is that a simple correlation, or is there a direct physical mechanism at play here?
There is a direct measurable physical mechanism, and it all revolves around complexity driven by new transistor architecture. We are talking about the move from FinFET to gate-all-around, or GAA transistors.
Right, at the 3 nanometer and 2 nanometer nodes being built by TSMC, Intel, and Samsung.
Exactly. With FinFET, you essentially had a vertical fin of silicon. With GAA, you were wrapping the gate material entirely around 4 sides of the conducting channel, forming a nanometer scale wire.
And why is this so critical for AMAT?
Because you cannot carve that GAA structure. You must build it up layer by vertical layer using extremely precise deposition and etch cycles.
So the complexity of the manufacturing itself is the goldmine.
It is. GAA requires significantly, perhaps even exponentially, more deposition steps per wafer pass compared to the older architectures.
More steps means more tools.
More steps mean longer process times, higher tool utilization, and, crucially, foundries need to buy more sophisticated AMAT tools just to achieve the same wafer throughput. The complexity of the leading edge is a direct secular growth driver for AMAT's CapEx.
That analysis highlights the structural tailwinds, but to truly understand the investment case, we have to analyze the revenue composition, because that shows where the inherent cyclical risk still lies.
Right. When we break down that semiconductor systems revenue, we can really separate the secular engine from the cyclical volatility. The largest portion, about 73% of total revenue, is foundry, logic, and other. This is the AI and advanced computing core.
Okay.
This segment is secular because the race for compute, power driven by GPUs, custom accelerators, leading-edge mobile chips, that race is not slowing down. This is the bedrock that justifies the re-rating.
Now let's look at memory. DRAM exposure sits at around 23%. Historically, this has been the volatile one. Is it still a major risk?
It is still volatile, but its current driver is highly secular, high bandwidth memory, or HBM stacking.
Which is mandatory for AI servers.
Mandatory. They need massive bandwidth to feed those fast GPUs. HBM involves vertically stacking DRAM chips using incredibly precise technology called through-silicon vias, or TSVs, and other advanced packaging techniques. This directly benefits AMAT's packaging and specialized deposition tools. I mean, the demand is so explosive that revenue from AMAT's leading-edge DRAM customers actually grew over 50% in the last fiscal year.
Wow.
So while DRAM is cyclical, it's currently riding an AI-fueled supercycle, which, it masks the downside risk for the moment.
And finally, the smallest but historically most painful segment, flash memory, at only 4%. This is 3D NAND, correct?
Correct. And 3D NAND is undergoing a painful cyclical trough right now, driven by inventory digestion across consumer electronics and lower CapEx spending.
But the long-term trend still helps them.
Absolutely. The long-term technological roadmap here also plays to AMAT's strengths. The industry has to move toward 300-plus layer stacks to increase density.
Which is a vertical challenge.
It's an extreme vertical challenge. Creating those structures requires high aspect ratio etch tools. I mean, imagine digging a well hundreds of stories deep and only a foot wide.
So even in their weakest segment, the complexity trend dictates a need for AMAT specialized tools eventually.
Absolutely. The cycle will turn, and when it does, the shift toward extreme 3D complexity, which means more deposition and more etch cycles, will resume. The complexity theme is the unifying constant across all their end markets.
The technical complexity story is compelling, but even the best technology is, worthless if the company collapses during a downturn. This brings us to pillar 2, the financial resilience. We mentioned that historical equipment vendors were boom and bust stocks. How did AMAT structurally engineer a way to fight that cyclical gravity?
They executed a brilliant multi-year transformation through their services division, Applied Global Services, or AGS. Historically, when a CapEx cycle ended, equipment sales went to zero and the whole company would just seize up. The solution was transforming the relationship from a transactional sale to a multi-year partnership centered on service. AGS generated a record $6.22 billion in fiscal 2024, which is about 22% of total sales. But the dollar amount is less important than the structural integrity of that revenue stream.
Okay, let's focus on that structural shift. How did they make the services segment truly sticky and predictable?
They moved heavily into a subscription model. Over two-thirds of that massive AGS revenue is now sourced from long-term agreements, LTAs, and actual subscriptions. And critically, in 2024, they began signing their first 5-year service agreements with major foundry customers.
5 years.
5 years. This provides unparalleled, visible, and high-margin recurring revenue that acts as a structural anchor for the entire company.
So a customer, especially a foundry running multi-billion-dollar factories, they're intensely focused on cost. Why would they agree to pay a premium for a subscription service rather than just handling maintenance in-house? What is the economic logic of uptime that locks them in?
The economics are simple, yet brutal. The cost of failure has become astronomical. As we move into the Angstrom era, the window of operation for these tools, the margin for error, has narrowed almost to nothing. Think of it like flying a supersonic jet. The calibration has to be flawless. If a tool goes down or if a minor drift in the plasma temperature leads to yield loss, a foundry is losing tens of thousands of dollars per minute. When a leading-edge wafer costs $50,000, they cannot afford a single mistake.
Wow.
So fabs are now demanding outcome-based contracts where AMAT doesn't just promise maintenance, they guarantee specific tool uptime percentages and yield performance metrics.
So the AGS segment is essentially an extremely high-margin insurance policy that the foundry has to pay for.
Yes.
Because the complexity of the technology is now beyond their own internal management.
Precisely. And this is why it creates what we call anti-fragility. We saw this play out in 2018 and again during the memory downturn in 2023. While the systems division revenue stalled, AGS revenue continued to grow robustly year over year. That service floor allowed AMAT to maintain its massive R&D spending $3 billion a year, while competitors were forced to retrench.
So they can invest through the downturn.
This ability to invest during downturns ensures they emerge from the cycle stronger, which is the definition of a structurally resilient business.
Let me play devil's advocate for a moment, though. Historically, services only mitigate a collapse. They don't prevent one. If the entire semiconductor economy went into a severe multi-year depression, I'm talking a 2001-style crash, isn't that structural weakness still present, even with AGS?
It is, but the composition of the weakness has changed. In the old model, the revenue was entirely discretionary CapEx. In the new model, 22% of revenue is mandatory operating expense linked to multi-year contracts. That floor prevents the company from falling below a critical level of cash generation. Furthermore, the structural demand for complexity, the shift to GAA, HBM, and 300-layer NAND means that even when demand slows, the need to transition to the next process node rarely stops entirely.
So the trough isn't as deep.
The severity of the historical bust has been structurally mitigated by the complexity trend and by AGS.
That resilience is crucial, but true long-term compounding requires a wide, durable, competitive moat. When we assess AMAT, we see three interlocking advantages: high switching costs, intangible assets, and ecosystem integration. Let's start with the one that dictates the rhythm of the entire industry, the copy-exactly doctrine.
The stickiness of AMAT's tools is legendary, and it stems from how chips are qualified. The copy-exactly doctrine mandates that once a specific tool, say an AMAT deposition system, is qualified and designated as the process of record for a given chip design and process node, it cannot be changed, ever.
And why is changing it so risky and financially prohibitive?
Because the manufacturing process for a leading-edge chip is less like engineering and more like a high-precision 1400-step bespoke recipe.
Okay.
You are tuning hundreds of variables simultaneously: plasma composition, gas flow rates, temperature profiles. If you swap out one specialized piece of equipment, even for a tool with identical specifications from a rival, the minute physical differences in the chamber walls, the heating elements, or the plasma uniformity can subtly change the output. To requalify that entire recipe, the foundry has to spend hundreds of millions of dollars and risks weeks or even months of catastrophic yield loss.
Delaying their flagship product launch.
Exactly. The risk is so high that they simply refuse to do it.
That's phenomenal leverage. It means that once AMAT is in the door for a generation of chips, they are locked in for the decade-long lifespan of that factory.
Exactly. This is why platforms like their Endura system are so sticky. The Endura has been the industry standard PVD platform for copper interconnects for over 20 years. They continuously evolve the capabilities within that proven common chassis. So when the industry shifts from copper to ruthenium for 2-nanometer nodes,
They just slot a new module in?
AMAT simply integrates the new ruthenium deposition modules into the familiar Endura chassis. Customers stick with the platform they know and trust, which reinforces that generational loyalty.
That generational dominance is built on consistent innovation, evidenced by their commitment to spending nearly $3 billion annually on R&D. That creates an intangible asset mode of proprietary process knowledge and patents. Let's look at two specific case studies that show how they are expanding that moat by actually disrupting adjacent markets.
The first is the revolutionary Centura Sculpta system, which they market as materials-eating lithography. It's a clear move to capture value from competitors.
Okay, so what specific problem were chip makers facing that necessitated this invention?
When you use EUV lithography to print ultra-fine features, think of lines thinner than 10 nanometers. The exposure often isn't perfect.
Right.
Historically, to correct for this and maintain resolution, chip makers resort to double patterning. They expose a wafer once, process it, and then expose it again. This is incredibly slow, doubles the processing time, and introduces defects.
A huge bottleneck.
A huge bottleneck.
Yeah.
Centura Sculpta is stunning in its ingenuity. After the first exposure pass, it uses a unique ribbon beam plasma process to physically shape, stretch, and correct the pattern imperfections on the wafer.
So it's like a plasma-based editing tool.
It essentially cleans up the lithography mess using material science.
So they're using a deposition etch tool to eliminate the need for an extremely expensive lithography step. Can we quantify the economic force of that disruption?
Can. This innovation fundamentally alters the capital intensity of the fab. By eliminating the need for that second high-cost lithography step, Sculpta saves customers an estimated $250 million in capital expenditure per 100,000 wafer starts.
$250 million.
They are providing the customer with massive CapEx savings, making their tool an irresistible proposition.
That is AMAT actively cannibalizing a portion of the patterning market, a market traditionally reserved for their sometimes rival, ASML. It's a proactive expansion of their moat into their neighbor's territory.
That's strategic genius. Now let's look at the razor blade dynamic they use in memory with the Pioneer and Draco hard masks.
Okay.
This is a classic lock-in scenario achieved through co-optimization. When scaling DRAM, you need structures with extreme aspect ratios. When you use plasma etching to dig those deep structures, the protective patterning mask used to guide the etch often gets destroyed before the job is finished.
So the tool is too powerful for the guide.
Exactly. AMAT solved this by developing a proprietary material stack, the Producer XP Pioneer, a specialized CVD film, and the Draco hard mask material. These materials are engineered with extreme etch selectivity, designed specifically to withstand the harsh plasma environment.
And the lock-in is that the tool and the material are inseparable.
Precisely. These proprietary materials are co-optimized with AMAT's Sim3Y etch systems. The tool is designed to work optimally only with the unique chemistry and properties of the AMAT materials.
So you buy the razor.
And you're locked into buying AMAT's blades, which are often high-margin consumables. It's a self-reinforcing dependency, where the specialization of the process guarantees recurring revenue and deep customer dependence.
Moving to the cutting edge of advanced packaging, we find the next massive frontier: 3D stacking and the chiplet economy. This is driven by the need to break through the memory wall, the processor computing faster than it can access data. The solution is hybrid bonding. How is AMAT leveraging its position to dominate this space?
Hybrid bonding is the technological answer to the memory wall. It involves bonding two silicon wafers or dies together directly using minuscule copper-to-copper pads, creating incredibly fast interconnects. It requires unprecedented precision and process integration. Recognizing this, AMAT made a highly strategic, non-controlling move by acquiring a 9% stake in BE Semiconductor Industries, or BC, the leader in high-precision die placement.
A minority stake, so it bypassed the regulatory risk.
Exactly. It secured access to critical back-end technology without the headaches of a full acquisition.
And this collaboration culminated in the Kinex platform. What makes this integrated platform such a critical moat advantage?
The Kinex platform is the industry's first fully integrated die-to-wafer hybrid bonding solution. The critical advantage it solves is the Q-time problem.
Okay, what's that?
Copper oxidizes almost instantly when exposed to air. If you clean and planarize the wafer, which is AMAT's specialty, and then let it sit for even a few minutes before the high-precision pick-and-place step, which is BC's specialty,
The pads oxidize.
the copper pads oxidize, ruining the bond yield. Kinex integrates the cleaning, planarization, inspection, and high-precision placement steps into one continuous, hermetically sealed process flow.
So there's no air exposure.
It dramatically reduces Q-time to near zero, ensuring high yield. Competitors offering piecemeal solutions, one tool for cleaning, another for placement, they cannot match this integration. This full-stack solution gives AMAT a unique, wide moat advantage in the burgeoning chiplet economy.
While the moat is wide, the competition is ruthless. The wafer fab equipment, or WFE market, is a highly consolidated oligopoly. AMAT is the largest by revenue, but it faces constant specialized threats. We need to analyze this rivalry and understand where the tension lies.
Let's start with ASML, the lithography giant. This relationship is complex, cooperative because they are both necessary for the leading edge, but competitive because their technologies occasionally overlap.
Right.
The tension is clear in two areas. First, Sculpta, as we discussed, directly reduces the need for ASML's expensive multi-patterning solutions. It effectively lowers the unit volume needed for advanced patterning. That's competitive tension. Second, the upcoming high-NA EUV lithography, ASML's next generation, it requires ultra-thin photoresists. Thinner resists mean that the subsequent deposition and etch steps need to be exponentially more precise to define the features.
Which helps AMAT.
This increased need for advanced deposition tools offsets the Sculpta risk and actually drives demand for AMAT. It's a dynamic balance where they constantly push against each other technologically.
Okay, so what about the real hand-to-hand combat with Lam Research? They compete directly across deposition and etch. Where has Lam traditionally held the structural advantage?
Lam's historical strength has been its dominance in 3D NAND high aspect ratio etching. They developed incredibly sophisticated plasma etch tools designed specifically to dig those vertical capacitor holes, and they own a significant chunk of that memory market.
So how is AMAT aggressively countering that? They can't afford to lose ground in etch, especially with the demand for 3D architecture growing.
AMAT is deploying its latest etch platform, the Sym3 Magnum, to compete aggressively across all domains. But the future battleground is the Backside Power Delivery Network, or BSPDN.
Right, this is the new architecture for 2 nanometers and beyond.
It is. It shifts the power lines to the back of the wafer to free up space on the front for transistors. Both Lam and AMAT are fighting fiercely for the etching and cleaning market share in BSPDN. However, AMAT has a structural advantage here because the final steps of BSPDN require highly specialized metallization.
Laying down the metal wires.
Depositing the specialized copper, ruthenium, and molybdenum films to conduct the power. Because AMAT's Endura platform dominates those metallization steps, their integrated offering for the entire BSPDN flow often wins the day over Lam's standalone etch solution.
So integration beats specialization again.
At the leading edge, yes.
Finally, we have Tokyo Electron, TEL. Where is the overlap and how does AMAT maintain its differentiation?
TEL is a powerhouse in the coater-developer tracks, the systems that apply and remove photoresist before and after lithography. They also compete with AMAT in certain areas of thermal processing and batch cleaning system. The differentiation is largely based on precision versus throughput. As chip complexity explodes, the industry increasingly favors the higher precision and lower variability of AMAT's single-wafer processing tools over TEL's traditional high-throughput batch processing systems, especially when you're dealing with Angstrom-level features.
So TEL might win on volume for older nodes.
But AMAT owns the high-margin, leading-edge complexity.
Technology and Moat are nothing without the financial results to back them up. When we look at AMAT's financial performance over the last decade, the structural margin expansion is perhaps the most compelling piece of evidence that the business transformation is complete.
It speaks volumes about their pricing power and efficiency. Over the last decade, AMAT's gross margin has expanded by approximately 800 basis points, climbing from around 41% to an impressive 47.6% in the last fiscal year.
800 basis points of margin expansion for a large industrial company is not small. That doesn't happen by accident. What specific strategic pivots drove that massive improvement?
It was a two-pronged attack. First, the strategic shift toward integrated material solutions, or IMS. Instead of selling a deposition tool and an etch tool separately, they began selling integrated multi-process platforms.
Got it.
These IMS solutions offer higher value, solve more complex problems for the customer, and thus command significantly higher prices and margins. And second, the successful scaling of the AGS subscription business. Services revenue carries substantially higher margins than hardware sales. So as AGS revenue grew to 22% of total sales and became subscription-based, it naturally pulled the overall growth margin upward.
Right.
Furthermore, they are demonstrating robust operating leverage. Operating margin is now approaching 30%. This confirms that the growth in high-margin IMS and AGS sales is substantially outpacing the growth in operating expenses, even as they continue to pump that $3 billion into R&D.
They're getting more efficient as they grow.
More efficient as they grow larger and more complex.
Let's talk about the lifeblood of a growth company, cash generation. How has AMAT performed on free cash flow?
Exceptionally well. They have achieved elite capital efficiency, generating massive free cash flow, or FCF, that reached $7.49 billion in the last fiscal year.
And the quality of that profit is high.
Very high. Their FCF conversion rate is almost 100% of their non-GAAP net income. This means their profits are not tied up in inflated working capital or questionable accounting. The money reported as profit is physically landing in the bank account.
And that cash funds the balance sheet.
It allows them to maintain a fortress-like balance sheet. They hold $7.0 billion in cash and equivalents against only $6.8 billion in total debt. They are net cash neutral. This is a deliberate, conservative strategy that allows them to weather any cyclical shock, fund strategic partnerships, and crucially, continue aggressively returning capital to shareholders.
The CEO, Gary Dickerson, has driven this entire transformation, prioritizing efficiency and the long-term PPAC framework. So how has the management team performed in allocating this massive cash flow pile?
They are disciplined and highly focused on shareholder return. Following the regulatory setbacks with the failed Kokusai acquisition, they largely abandoned large-scale, empire-building M&A. Instead, they focused on what we affectionately call the Cannibal of Santa Clara, aggressive share repurchases.
And 2024 was a banner year for the Cannibal.
Absolutely. They repurchased $3.82 billion of stock in the last fiscal year alone. By continuously reducing the share count, they have been efficiently increasing the ownership stake of every remaining shareholder. It's a capital-efficient way to compound returns.
That pivot to minority stakes, like the 9% in BC, is a fascinating strategic choice post-Kokusai.
It is a hallmark of intelligent, adaptable management. They learned the lesson that large acquisitions in the WFE space attract geopolitical and regulatory scrutiny. This pivot allows them to gain access to critical, cutting-edge technology like hybrid bonding expertise in a capital-efficient way, securing the technological advantage without risking another multi-year blockage.
Finally, let's address the subtle signal of insider activity. The compensation is well aligned with shareholder returns.
Yes, weighted heavily toward relative total shareholder return and margin targets.
But we do see a net pattern of selling by key executives. Should investors worry about that lack of open market buying?
It's an important nuance, but not necessarily a red flag. The selling we see is largely systematic, related to vesting and stock-based compensation plans.
Right.
The crucial signal is the absence of open market buying. If management believed the stock was dramatically undervalued, they would be buying. Their current behavior selling systematically and not buying suggests that while they are immensely confident in the business execution, they likely view the stock as fairly or perhaps even fully valued at these elevated levels.
It's a check on exuberance.
A subtle check on investor exuberance, yes.
That leads us to the critical final pillar, valuation and risk. If AMAT is a wonderful company with a fortress balance sheet, we still must avoid paying a price that assumes perfection.
And the current multiple is the friction point. AMAT is trading at a forward PE of approximately 25.4x.
That is significantly higher than its historical norms, right?
Yeah, it is. That 25.4x is a significant premium to its long-term 10-year average PE, which sat around 18x. Historically, during memory cyclical troughs, the multiple could compress dramatically, sometimes into the low teens.
The market is clearly signaling a fundamental re-rating. So what is justifying that new, permanently higher multiple?
The market is reclassifying AMAT from a cyclical hardware industrial to a secular AI infrastructure enabler. The justification is simple. The combination of reduced cyclicality due to the AGS floor and the explosive non-negotiable demand for complexity driven by GAA and HBM means that the earnings floor is significantly higher than in past cycles.
So investors will pay more for that reliability.
They're willing to pay a higher price for those more reliable earnings. In peer comparison, AMAT trades at a discount to KLA and ASML, which has stronger vertical monopolies.
Yeah.
But it's trading in line with its direct rival, Lam Research. The valuation reflects the complexity, competition, and secular demand, but it certainly prices in a substantial amount of future success.
If valuation is the pressure point, geopolitics is the largest quantifiable risk. The semiconductor supply chain is now a geopolitical battleground, and AMAT has direct exposure to U.S. export controls aimed at limiting China's access to leading-edge technology.
This is the critical headwind that cannot be ignored. The U.S. Department of Commerce rules are specifically designed to restrict the sale of advanced equipment. AMAT has already quantified the immediate impact. These restrictions are projected to create a revenue air pocket, reducing their fiscal 2026 revenue by approximately $600 million.
$600 million.
That is a direct structural headwind to top-line growth.
The short-term hit is painful, but what is the potentially permanent long-term threat stemming from this decoupling?
The deeper risk is incentive acceleration. By severely restricting access to AMAT's most advanced Angstrom-era tools, the U.S. is creating an existential imperative for Chinese domestic competitors like Endura and AMAT to accelerate their R&D dramatically.
We're forcing them to get good fast.
Exactly. Over the next decade, AMAT runs the risk of permanently losing market share in China, a massive and crucial global WFE market. For everything except the absolute most cutting-edge processes where the moat remains insurmountable for now. The restrictions serve as a massive subsidy to China's domestic WFE industry.
Even with the AGS floor, we can't forget that 27% exposure to memory. If the HBM supercycle slows down, or if the overall memory inventory glut returns, the stock will react violently.
It's an unavoidable structural risk despite the current strength. The memory industry is characterized by massive, rapid boom-bust cycles. If AI server demand hits a slowdown, or if DRAM makers complete their current HBM capacity build-out faster than anticipated, companies like Micron and SK Hynix will immediately slam the brakes on CapEx.
And we've seen this movie before.
We saw the stock price consequences of this in the 2018 crash. While AGS provides the floor, these cyclical shocks still create massive short-term volatility and price compression.
And finally, the constant technological arms race. AMAT has hedged against ASML's power with Sculpta. But what if the next jump in lithography technology renders some of AMAT's multi-patterning solutions obsolete?
That is the perpetual risk. While Sculpta is a phenomenal hedge, it cannibalizes multi-patterning before ASML can with new generations of EUV. The risk remains. If ASML's high-NA EUV becomes rapidly cost-effective and prevalent, it could theoretically reduce the need for some of AMAT's deposition and etch cycles that are currently necessary to resolve features.
So it's an ongoing battle.
It is an ongoing arms race, and the technological advantage must be defended with that $3 billion R&D budget every single year. So bringing this comprehensive deep dive to a close, let's issue our verdict based on the scorecard. Applied Materials is fundamentally a wonderful company. The business model is structurally sound, fortified by the high-margin recurring AGS revenue. It possesses a wide interlocking moat driven by generational platform lock-in, proprietary innovation, and critical ecosystem integration.
Strong management, fortress financials.
Discipline management, fortress financials built on elite capital efficiency. The core investment thesis boils down to this. AMAT is the most essential pick-and-shovel provider for everyone building the AI revolution. Unlike a component maker, whose dominance can be challenged by a rival GPU or custom silicon, every advanced Foundry, TSMC, Intel, Samsung must use AMAT's tools to achieve the required levels of atomic complexity. Their indispensability is their ultimate asset.
Given all this foundational strength and the undeniable secular tailwinds, what is the actionable recommendation for the long-term investor? Applied Materials is absolutely suitable for long-term ownership as a core technology holding. It is a generational company fully aligned with the increasing complexity of the digital world. However, prudence dictates patience right now. Given the current premium valuation trading significantly above its historical average at 25.4x PE and the quantifiable impending $600 million revenue reduction due in fiscal 2026 from geopolitical controls, the stock is not a value proposition today. We recommend accumulating on weakness. Investors should target entry points when the inevitable cyclical volatility driven by memory shocks or short-term geopolitical pessimism forces the stock price down. That allows the PE ratio to compress back toward its long-term historical average of 18x to 20x. That cyclical pullback is the opportune moment to establish a deep, long-term position in a fundamentally excellent company.
And here's the final provocative thought we leave you with. Applied Materials is not simply a financial asset. It is a direct index of human technological aspiration. Their entire investment case hinges on one single question. Can you imagine a world where the demand for complexity, the need for more power, greater performance, and smaller area in silicon stops increasing? As long as that demand accelerates, AMAT's tools will be the first things ordered by every major foundry on the planet.